Welcome, everyone. Thanks for joining me. My name is Nathan Faith. I'm a financial planner at Boulay Financial Advisors. I'd like to take the next few minutes to talk through the new law called the American Rescue Plan, which is round three of the stimulus programs that have come out from the federal government over the last year. There's a lot more to this law than there has been in past laws, specifically on the planning front. Things you can do after the law is passed to really impact your financial situation. So let's get started. First, let's talk about the direct payments, the stimulus checks, the things that have been most publicized in the media. This go around, the checks are big, actually about twice as large as they have been with the first two rounds. For this round, the maximum that can be received per person is $1,400 versus just $600 in the first two rounds. This round can be even bigger though. Instead of counting children under the age of 17 and adults in a household, all dependents on one's tax return can count. And now college kids are part of the mix too. In the last rounds, they were completely excluded. As with the last two rounds, the money is means tested, meaning the checks actually go away or phased out as your income based off of your adjusted gross income on your tax return goes up. So let's look at how things changed under this new law versus the old. Under the past two stimulus programs, you would receive all of your stimulus payments if your combined income as a married couple is below $150,000. Those checks were then slowly phased out over the next $50,000 of income until you were out of luck once your income exceeded $200,000. Know that under the new program, the phase out is much tighter, essentially a cliff fall. Once your income exceeds $150,000 for a married couple, instead of receiving a $2,800 direct payment, if it's just two adults in a household, your payment would be reduced to zero once your income goes up by just $10,000 to $160,000. For single folks, those phase outs are cut in half. You may think it's too late to do anything about these checks because the law's already been passed and the IRS is going to look at your most recently filed tax return. If your income's above $150,000 on your most recently filed tax return, if you're married, you would think you'd be out of luck. However, there are three checkpoints to qualify for the full direct payments. The first is based off of your tax return filed as of really the law passing within the last few days. However, if you have not yet filed your 2020 tax return, you have until July 15th, 3 months after the April 15th deadline, to file. And if your income is below this $150,000 threshold, you'll be trued up, essentially caught up and paid for those direct payments. And if your income's still too high in 2020, you actually get another opportunity when you file your 2021 tax return next April. And again, if your income is below that phase out range, starting at $150,000, you again can qualify for the full direct payment. So now let's move on to another stimulus program, specifically an extension to unemployment benefits. These have been extended and enhanced several times prior, but now they've been pushed out to September 6th of this year. And the $300 weekly bump to the state unemployment benefit will continue from the federal government until then. Now, for those of you who have not yet filed your 2020 tax returns, if you claimed any unemployment whatsoever, know that there's a change in which the first $10,200 per person who received unemployment in your household may receive that income tax-free. There are phase outs. So again, for a married couple at $150,000 of income or below, your unemployment checks would be tax-free. But if your income's $1 above that line, all of your unemployment checks would be fully taxable. So now let's move on to one of our biggest expenses, health insurance. Under this American Rescue Plan, there's potentially free health insurance for those who are hurting. First, if you were laid off by your employer involuntarily, Your employer will be paid by the federal government to cover your health insurance from April through September of this year. And subsequently, you as the laid off employee would get free coverage through Cobra for those 6 months. Alternatively, a big item that hasn't been publicized by the media is that if anyone in your household has been enrolled for just 1 week of unemployment benefits at any point through 2021, you can qualify for free health insurance through the exchanges, also known as Obamacare, in which you receive free health insurance for the entire year by just receiving 1 week of unemployment benefits. And while we're on the topic of Obamacare, it was subtly enhanced for the next 2 years within the law. And while we're on the subject of Obamacare, it was subtly expanded for 2 years under the American Rescue Plan. What is Obamacare? Well, if we look at the old system, for a married couple, if they paid for health insurance on their own, the average cost for those in their late 50s, early 60s is $20,000 per year. And because Obamacare is means tested for those who either make too much or, believe it or not, make too little, they have to pay the full cost of health insurance. However, for a married couple with income between approximately $20,000 and $65,000, as reported on their tax return, their health insurance premiums are greatly subsidized through a credit called the premium tax credit. And at the lower end, their health insurance cost is reduced by about 90% to $2,000 per year. And just below that red line at $65,000 of income, their cost is only $6,000. And the government would subsidize the remaining $14,000 with Obamacare under the old system. However, for the next 2 years, really throw that out the window. What's happened is for those who are married without children, who have income below approximately $30,000, they would have no cost for their own health insurance. The $20,000 premium would be completely paid for through the premium tax credit by the federal government. And the amount of income that can be earned and still receive credits, aka subsidies from the federal government, has gone up fourfold. So again, if we reference that $65,000 income line for a married couple, instead of having to pay the full cost above that line, only 8.5% of one's income above that line is required to be paid towards health insurance. So at $100,000 of income, 8.5% is $8,500, meaning Uncle Sam would cover the other $11,500. At $200,000, it's $17,000, 8.5% of one's income. And only at about $235,000 of income would someone have to pay for the full cost of their health insurance. And that's the case for the next 2 years. So for those of you with children, please listen up, because some major planning opportunities exist for you in the year 2021. First, there's an enhanced child tax credit. Normally, this is $2,000 per child that you have in your household below age 17, as long as your income is below about $400,000 for a married couple. However, for this year, there's essentially an extra credit applied to your existing child tax credit. So the extra amount is $1,000 for every child that you have in your home between the ages of 6 and 17. But for the little ones that are 5 or younger, the credit's bumped up a bit further to $1,600. But again, as you've seen over and over again, these are means tested, so they're phased out, specifically for these extra credit amounts. So let's look at a married couple with 2 young kids under the age of 5. If their income is below $150,000, they'll qualify for the full $3,200 extra credit. However, the phase out is over the next $25,000 of income. And once their income exceeds $175,000 on their tax return under adjusted gross income, they lose out completely on this extra child tax credit. But that's not all for those, especially with young children. If you have large daycare costs, there's a special tax credit called the dependent care credit. Typically, this isn't worth very much, sometimes as low as a couple $100. But that's definitely not the case for 2021. Whether you're married or single, you can count the first $8,000 of dependent care expenses towards this credit. And the federal government will cover up to half of those costs in the form of a tax credit. So let's take a look at an example. Assume that a married couple has two young children and combined they have at least $16,000 of daycare costs. They'd be eligible for up to an $8,000 tax credit as long as their income is below $125,000. Now that's their AGI in their tax return. Over the next $60,000 of income, that credit is phased down from $8,000 to $3,200. But then it's safe. It holds up for a while, really between that point and $400,000 of income. But then a second phase out zone occurs. And once one's income exceeds $440,000, the remainder of that credit is completely phased out. The combination of the dependent care and child tax credits can amount to over $10,000 in tax savings for folks with a couple kids here in the year 2021. There's a lot buried beneath the surface with this new stimulus law. And 2021 could be a year in which financial planning really plays a big part as you monitor your income and identify if you're going to be above or below some of these phase out lines and planning targets. Know that strategies that could shift for this year would be switching to pre-tax contributions to your 401ks and retirement accounts, maxing out your health savings accounts, dependent care FSAs, and the like. If you'd like to review your planning further and see what the benefit for your decisions is, please reach out to us directly or email us at learnmore@bouleygroup.com.